Well, good morning, everyone that's joining me live this morning. Welcome to this month's afterMATH webinar. We'll talk about yesterday's USDA report and quite a bit more. The report, just to give you the quick and dirty, the report didn't have a whole lot in it meat-wise. I think the meat is coming up here as we get into late June and July, August. Then you start seeing USDA make some changes on the production side, but certainly the markets have been moving, and we got a lot to talk about there this morning. Before I get into some of the crop markets, and just a little commercial, but if you check out the market report letter each day, I have the heat check column in there. We talk about the hot markets and the not markets, and we'll identify a few of those that we talk about every day. But if you look at this is a copy from last night, you can see we got a lot of knots in here. We got a lot of blue ones. Don't have any hot markets at the moment. We did take December corn out of the knot zone the last couple of days. It's bumped back up a little bit, but we still have several markets struggling. The wheat market, the cotton market, the hog market in particular, all continue to be in the knot zone. Some of the other markets that we don't talk about a whole lot that are hot right now, the S&P. If you look at the S&P index, continues to fire up over 5,400 points. Really been driven by the tech stocks. And if you look at NVIDIA, I think it's pretty evident here that NVIDIA has been on fire over the last, couple of years, but in particular over the last couple of months, the NVIDIA market, NVIDIA is challenging, in Microsoft and Apple, I guess, for dominance in the AI world. And so that's a world that kind of escapes me. I'm not a big AI person, but nonetheless, it seems to be the way of the future, I guess. And another hot chart is hiring by the federal government. Saw this yesterday. Federal government jobs are at an all-time high right now. So imagine that. Going into the knots, some of the other charts, the consumer price index yesterday showed that inflation has continued to creep a little bit lower, down to 3.3%. It's still too high. And again, that's 3.3% above last year. So prices aren't going down. It's just that the rate of them going up has started to dip a little bit. And the Fed says it wants to get to 2%. So we're still a ways away from getting to the 2% level. Where is the inflation at over the last 12 months? This is a pretty good chart that Yahoo Finance put out. You can see where the big movers are. Auto insurance up over 20%. Housing and rent, certainly one of the big ones as well. And you can see some of the other numbers here. Where we saw a little bit of a dip, I think from last month, was supposedly in fuel prices coming down a little bit. And that maybe lowered some of the overall inflation numbers. The hog market. Hogs are definitely at the bottom of the knot zone right now. Over the last week or so, we kind of thought that maybe this double bottom from back in October and December would hold the bottom side of this market. It didn't. And so the hog markets continued to sell off. And so I had to go back to the weekly chart to see when's the last time hogs were at a lower price, I guess. And if you look at the nearby hog market, you can see that back at the end of December, we had traded down below $90. And so maybe, you've got some other support points here, but this market's way oversold right now, probably due for a correction. If I was going to buy something right now, it'd probably be the hog market on a flyer. But for the moment, we're just trying to find that support. So some of the other big factors in the markets right now, of course, the U.S. crops, crop progress, conditions, those are going to continue to be monitored on a weekly basis, really on a daily basis. We're going to be watching weather now. We've got this June report behind us. Weather will take precedence in these markets over the next few months. In addition to that, let me mention that June 28th is the next planted acreage report from USDA. And so that's going to be a big day. Will USDA, go back to March and you remember the planting intentions report. And USDA told us we were planting 6 million less acres of cropland this year versus last year. Most of us were confused by that. But that said, there are some people out there that think that they overdid last year's crop number. And so this will give them their next opportunity to make a correction. And so June 28th, 2 weeks from tomorrow, be a pretty big day. In addition, we've got world wheat crops right now that are under some pressure. We've got drought in Russia. We've got drought in China. The EU, certainly there's some areas of the world that have given this wheat market a little bit of boost. South American crops are pretty well done now. The only thing we're still watching is the second corn crop in Brazil. The managed funds, what are they doing with their positions? Certainly continue to control the market a lot. So we always follow them. And then lastly, the seasonals. And we always try to remember to remind everybody that, you know, seasonally, this is the time of the year where the markets give us our opportunities to do selling. Doesn't always happen every year, but we certainly want to be paying attention. So I want to start out with weather, because I do think that as of today, weather is the most important factor for the market. And we did have our new drought monitor out this morning. It's incredible, I think, that if you look at the numbers, I think the corn area that's under drought right now is 2%, and soybeans were 1%, which that's the lowest I can remember in many, many years. So I know we've had some struggles in some places getting the crop in the ground because of too much rain this spring, but you know, the flip side of that is we don't have any of the corn soybean areas that are really being impacted that much. Certainly Southwest Kansas is the area that we're watching closely, but even the Texas Panhandle has gotten a lot of precipitation, and they fixed some issues as well. So at the moment, we don't have a lot of cropland that's under pressure. And if you look at the change over the last month on the left and 2 months on the right, you can see that we fixed the drought in Iowa really fast this year, probably too fast for some folks. I know I've heard from some folks in Northeast Iowa that, you know, they've been struggling to get the crops in the ground because of too much water. And I think of some of the unplanted corn and soybeans left, a lot of it is in Northeast Iowa, southeast Minnesota, southwest Wisconsin, northwest Illinois seems to be a pocket where there's still struggling to finish up the planting this year. This morning, we had the new ENSO data come out trying to tell us when La Nina is going to arrive. And I think they put a 65% chance that July, August, September is when La Nina is going to show up. And so what does that mean? Well, historically, it's meant hotter and drier conditions. And so what we've been rooting for all along is the later, the better. I think it gets to, gets up to 80% here, September, October, November. So early on this year, there was talk that by June, July, we could see La Nina arrive. The good news is it looks like it's going to be later than that. And so it may not, especially for early planted crops this year, may not have as much pressure on those crops. For later planted crops that are going to mature maybe into August and September, you could maybe see some more impact from it, at least in a broad scale. So the other thing that we'll be watching is next year. And I know it's way too early to talk about 2025, but you know, if this La Nina lingers into next year, what's the impact? And so that's going to be looked at now. And you can look at this scatter chart here, shows, I don't know how many different models about the timing and the percentage, et cetera, et cetera. So if you're into that kind of thing, knock yourself out. Most of us probably going to be looking at the nearer term forecasts. If you look at the latest 5-day map, it does show the Western Corn Belt getting pretty good rainfall, sliding over into Northern Illinois, Western Illinois here over the next 24 hours. I heard I'm in Southwest Illinois, and I heard a forecast last night saying we could see wind gusts tonight up to 75 miles an hour with a little bit of hail thrown in. So we'll see what happens. But again, we'll see what happens. Looking at the extended maps, the 6 to 10, 8 to 14 day maps, everybody's calling for above normal temps for much of the country. And you can see precipitation wise that the northern belt continues to be fairly wet, And as you move east, maybe a little bit on the drier side, but at least we don't have a stuck weather pattern from a precipitation standpoint that's keeping any kind of a keeping movement out. In other words, it looks like we've got pretty good flow. These above normal temp maps, I have trouble figuring out what above normal temps are anymore, because I think we've been looking at above normal temps for the last 3 to 4 years. So I think maybe that's just the pattern that we're in. Now, if you look at the longer term forecast maps, July, August, September, October, again, above normal temperatures. But the precipitation maps at the bottom, and now these are about 3 weeks old, but these really show you the arrival of La Nina. And this is from NOAA, and they're showing typical La Nina. You see dry temperature or dry situation move from west to east, and that's kind of what they're showing. One thing that's pretty interesting, and I don't have it on here, is Mexico right now. If you look at Mexico right now, their drought monitor, it is bone dry down in Mexico right now. So La Nina has already arrived in Mexico. The little girl has brought really, really dry conditions into Mexico, where that could come into play, possibly for U.S. corn exports. Certainly, you could see Mexico import more U.S. corn this year. Looking at a different set of maps, the CFS model for July, August, September, August, Sep-Oc, again, above normal temps. And you can see down at the bottom, the arrival of La Nina starting to show up. A little bit drier in the east on this model than what we were seeing on the other models. So we're going to continue to watch these. These will continue to drive the market. Really, to me, the 2-week forecast maps are the ones to watch. I don't, get much out past 2 weeks. It's kind of hard to forecast much here. So, but that said, funds like to position themselves just in case. And so if a fund trader's too long or too short and they're nervous about what could happen, you may see some position evening up. And with the funds short right now, you've seen them be a little bit of a buyer the last couple of days in the corn market. So we'll start out looking at corn. Yesterday was a non-event. USDA didn't change any of the numbers. Again, I think they're going to wait until after this June acreage report. So July, we'll probably see some changes to the new crop balance sheet. But USDA is still forecasting old crop ending stocks a little over 2 billion bushels. Next year, they're still using a 181 yield, still using demand at 14.8 billion, still showing ending stocks at 2.1 billion bushels. And they're still showing an average farm price at $4.40 for the 2024 crop. And again, if you compare the stocks to use to average farm price chart, I showed this through the winter. Stocks not forecasted to be quite as big as we were talking maybe back in Jan, Feb, March, and price maybe not quite as bad as we were talking at that time, but you can still see the inverse relationship in the two. And, when we have ending stocks up 14-15%, we typically see lower prices. The positive has been the exports. We had lower prices have been the cure for lower prices, and we've seen exports pick up this year. Not stellar by any means, but you can see the gold line compared to the dark red line. We're doing better at shipping corn this year, and we're still running above last year. So again, the lower prices have started to stimulate more demand. We are seeing countries, a lot of the ones that we count on, Mexico being one, Japan, Colombia, South Korea, the big buyers historically have been back buying U.S. corn, especially the Mexicans. And again, pointed out the drought monitor and what's going on down there. Ethanol has been good production this year until this week. We saw ethanol production last week drop back significantly, but you can see the number of blue, the number of weeks that the blue line on here has been well above what we've been the last few weeks. So we are starting to drum up more demand for corn. And we talked about that through the winter that, you need, at some point, you got to have prices try to seek out a level where you can stir up demand. And that's kind of been the case. So looking ahead at the what ifs, if you look at the stocks matrix right now, USDA says we're going to start the year at a little over 2 billion bushels. They say that demand next year is going to be a little over 14.8 billion. Right now, they're telling us that we are planting, or we intended to plant, a little over 90 million acres of corn, and we're going to harvest 82.2 million acres this year. And so they're using a 181 yield, and that would give us a carryout at 2.122 billion bushels next year. So the green numbers would remain, carryout would remain over 2 billion. You get down into the gray numbers, you know, you're 1.5 to 2 billion. And then the red would be below 1.5 billion. That's where you start to have to see prices rally to ration demand. And so what's going to happen with this acreage number? I think that's going to be the next big thing in 2 weeks when we get this acreage report. Is USDA going to lower that number? Dr. Cordonier with Pro Farmer, he took his acreage number down 500,000 the other day due to less planted acres, less probably some prevented plant. So we'll be curious to see, does USDA drop that number? Do they leave it the same? What do they do? But if you were to go down, say, to 89 million planted acres, you know, now at a 181 yield, you're down to 1953. If you get back to a more realistic yield, I think maybe 178, 179, you know, now your carryout's down around 1718. So I think that that's probably more realistic at this point. But again, we'll see what the government decides to tell us here on June 28th. And if you look at the world numbers from yesterday, USDA didn't change much. They did, in fact, they didn't change anything to speak of. But you can see how U.S. stocks have continued to grow. World stocks continue to be pretty flat here on corn. Looking at the funds, what are the funds doing? Well, the funds right now are short 212,000 contracts of corn, this gold line. Kind of ignore the dark and the light scattered stuff. Really, the blue is the price of corn, and the gold is the fund position. And you can see how they do tend to track well together. The funds tend to drive this market, but it also points out that the funds had reversed their position big time here this spring. You know, they had gone from short 350,000 net to short 100,000, and now they've added back 100,000. This is the time of the year where the funds are pretty wild with their positions. Oftentimes they, you know, if we get scared because of drought concerns, you can see these people come back in pretty darn quick, especially when they're short 200,000 contracts. I think you've seen that the last 2 to 3 days. The funds have been buying back some of their short positions just in case. However, it's also the time of the year we typically make our highs, and so that's driven by the fund buying that we're seeing. So we'll look at the charts here. July corn has, you know, we've come up off the lows. We're 21 cents off the low now. As of this morning, we were up about a nickel this morning when I updated the charts. Darren Fessler, who I follow on X, he pointed out that we've got kind of a head and shoulders formation forming in the chart in the corn market right now. And he's right. If you look at July corn, you know, we've had our peak or our head back in early May. We had our one shoulder back here at the end of March at 460, and that's just about where we're trading to here this morning. So it'll be very interesting to see where this market trades going into the weekend. Do we stall out here at this 460 level? Does the market have more upside potential? If you look at the RSI and the stochastics, it would tell you that this market's trending a little higher right now. And so I would probably want to target that head, that May high at 475, if I had old crop corn. And that's also just under the 200-day moving average at 477. So to me, that would be a good place to have some offers in up around that 475 level if this market's able to get a little more push. And again, we've bounced off of these other moving average lines, the 9, the 20, the 100, the 50. Those are all right here in this 450 area. So the fact that we were able to take that out has given us a little boost here. We'll see if we can push through that. Similar with December corn, if you look at the head and shoulder that would have been established, 481, 496 and 3/4. We were at about 474 here this morning. And so about 7 cents under where that other shoulder would have been. And so that to me is a first initial target for December corn. Can you get back to that 480, 481 area? If we're able to take that out, then 490, the 200-day moving average, looks again like a pretty good sales target for us. For anybody that needs to play some catch up on some sales. We've got a lot of lines on this chart. The crop insurance base price back in February was at 466. We're back above that again. To me, that's always a target. Can I mark it above that level? Number one, we do have a chart gap that was left back in at the beginning of the year at 502 to 503. I don't know what confidence I have we can get back there, other than it'd be weather that drives us there. And pretty plain and simple. The RSI and stochastics have turned higher. So this market is in an uptrending mode at the moment. So that's a positive. Can we get back above the 20 and the 50-day moving average at 475? And that kind of gives us that ground to then run to that shoulder at 481 again. So if you want to trickle out some hedges, that 480 area might be a good place. 490 would be a good place. $5. You might want to scale up here on some dime increments. You can also look at the options market. The one option that I continue to look at is this September short-dated option on December corn. The reason is you could use December options. They cost more money because they don't expire till late November. The September short-dated options are based on December corn. So you're using the new crop contract. It's just that you're not spending as much money on time value. These options have 72 days until expiration. So if I were to say hedge corn at 490, maybe I would jump out here and buy maybe a 520 call for 8 3/4 cents. And just in case the market kept going higher, I would have some potential upside. You could use puts if you want to protect the downside. I don't like that as well, because you spend more premium money and you don't get as high of a floor as you can if you hedge and buy out of the money calls. So I still prefer that way. Another thing, maybe you could look at call spreads, but you don't really get enough money by selling the out of the money call. You could get a nickel back by selling a 550. Maybe you could buy a $5 for 12 and sell a 550 for a nickel. Cost you 7 cents to have potentially 50 cents upside. You could do that along with hedging corn on a little bit of a bump. So there's just a couple of ideas. Options are infinite as far as the different possibilities you can do with them. If you really wanted to get creative, you could look at a 3-way option spread where you put in a floor. Maybe you buy like an at the money 465 put at 23.5 cents. You sell a below the market put and you sell an out of the money call. You create like a window in the middle just in case you're concerned about some limited downside movement. So there's a lot of different things that a person can do. If you're interested and you want something else to talk about, shoot me a note after the meeting. We'll be glad to look at some specific examples. Lastly, just want to leave you with this, the update on where we are this year compared to 2014, because that's something I talked about all winter long. When you look at the stocks to use ratio, what happened following 2012 for the next 2 years, and you look at what happened with corn price, we're in a very similar situation now. We're building stocks and prices have been trending lower, similar to what they did following 2012. And if you look at D's corn right now compared to what it was in 2014, holy cow, it's very, very similar looking chart right now, the chart on the right. So I'm not saying that we have to go down like we did in 2014, but again, if these acres do well and the crop condition stays at 74% good to excellent, we do have some potential downside risk in this market. Soybeans, USDA made one change. They lowered the old crop crush 10 million bushels. You can debate the reason for that. Some people are saying that old crop beans are tight in places and that the crushers are having trouble finding them. So I've seen that, the conspiracy theorists saying that USDA's overshot its production number from last year. So we'll see what happens, but they did raise ending stocks to 350 million bushels, carried that into next year's balance sheet, raised ending stocks to 455 million bushels. You can say what you want about the balance sheet, but to me, I still stick with the idea that beans are probably the most bearish balance sheet we've got right now. More so definitely than corn, more so than wheat at this point. because of the building of the U.S. stocks and because of the building of South American stocks. And so you've got us, and because of the struggle with Chinese demand. So you've got a lot of things working against the bean market at the moment. And if you look at the U.S. stocks to price chart, again, look at how we've mirrored a decade ago when stocks built and prices dipped for 2 to 3 years. We're in that similar situation right now. Back in 2012, when we had high prices, not only did we increase plantings in the United States, but we encouraged Brazil to really ramp up bean production. And we've done that again here this last couple of years. Brazilian acres have continued to increase, and therefore world stocks have continued to build. What's going on in the U.S.? Well, crush, I mentioned, crush demand had been running strong, and crush is one of those areas where we think we're going to continue to set records over the next couple, 3 years because of the new plants that are coming online. But this month's number was really much lower than expected, and kind of coincides with why USDA lowered that estimate for the old crop. So it was a little disappointing, I think, to the soybean bulls. Weekly export inspections, haven't been anything to write home about this year. We've had several weeks well below last year throughout our key shipping window from November through February. Now we're just kind of doing what we typically do. We've been shipping some auxiliary beans. The positive here has been that Unknown has bought beans from the United States the last 3 days. So we will see some beans shipped, not a lot, but probably filling in for what China has to get that maybe they can't load out of South America. But if you look at new crop bean shipment sales so far, China has bought 0 beans from the United States. And you look at compared to some of these past years, that's not typical. And so that's reason for concern. And there's been some suggestion that China's going to be shipping beans, or could be shipping beans out of Brazil all the way through the U.S. bean harvest, even into next December or so. And that would be ugly if we're sitting here in October, November, and don't have any bean boats to load. What's bean basis going to look like this fall on the river? That's a concern of mine. And so kind of think about that in your marketing plans, especially if you're shipping towards the water. Now, looking at the stocks matrix, again, if USDA tells us we're going to start at 350 million bushels, tells us we're going to use 4.36 billion next year, tells you the probability, if we planted 86.5 million acres and we have a U.S. yield at 52 bushel, we're going to be in a very comfortable situation. So a lot's going to, depend on this new acreage report coming out in 2 weeks, of course. Will this be higher or lower? Which way? But right now, you could have a yield at 51 bushel an acre, down a bushel, and still see stocks go up this coming year. And so that's why I don't think there's a lot of concern at the moment because of bigger acres this year and because of the struggling demand situation, that I don't think there's a lot of upside opportunity in this bean market, at least as of right now. If you get into that late summer La Nina situation, maybe that's different. You get into weather in August, September, but we don't see that at the moment. Looking at the South American numbers from USDA, they did lower one number, and that was the Brazilian bean crop. They're still higher than everybody else, and this number should be 153 for Brazil. But CONAB came out this morning. They're down below 150. Just about everybody and their brother is under 150 on their number except for USDA. So even if you take this number down another 4 or 5 million tons, their combined South American production is still a record this year. Next year, USDA is forecasting another new record, 169 for Brazil. I'm going to put money down and say that's going to be the highest number we see for Brazil's crop next year. I don't, the odds of them hitting that number is pretty hard, but they're telling us we're going to have more acres. The odds are that we're going to have another record production in South America, in the Southern Hemisphere next year. So you couple that with U.S. numbers, not necessarily a great situation. U.S. stocks to usage is in a building mode. World stocks to usage is in a building mode. So again, that kind of backs up my opinion that beans probably have the worst looking balance sheet here at the moment. The funds had bought back a big chunk of their short position. up until just recently. And last week they were net sellers again. They went back to 60,000 contracts short. But you can see they were nearly 200,000 short this spring, nearly bought all of it back. And now they've turned back on the sell side again. And it's what's pressuring the market. And we've still got beans in the not zone. If you look at the market report email, you got the RSI down around 42, stochastics pushing down into single digits. The 9-day moving average line, this red line, has continued to keep a lid on this bean market. We'll see if we can push through that today. But then you've got some other moving average lines here providing resistance to the upside as well. Looking at November beans, we are back below the crop insurance base price at $11.55, but we're still well below the margin protection price at $12.95 right now. That looks like a heck of a put option for any producer that bought margin protection on soybeans. But again, this 9-day moving average at 11.56. You've got these other moving average lines up around 11.80. All of these are going to keep a lid on this bean market, I think. And I don't know short term what we've got that can give us a boost. Unless USDA comes out with a lower acreage report in 2 weeks, bean weather really doesn't affect the market until you get out into probably August or at least late July. So for the moment, I just don't see us having a whole lot bullish here on the bean news, unless China does start to buy new crop U.S. beans, and we just don't see that happening at the present time. So what to do there? I guess I would have offers in up at this 200-day moving average at 12.20, probably a few pennies below that. I'd have some offers working around maybe $12 just to get caught up on some sales if this market's able to get a boost. But that's, 50 cents above where we're sitting at here today. You could look at options. If I do make a sale at $12, maybe I look at out of the money calls. The good news is that bean options are not that expensive right now. So if I were to hedge $12 beans, let's say if we get back up there, maybe I buy a $12.50 call for less than a dime, short dated, and that gives me some opportunity in case this market does get a weather rally here late summer. So there are some opportunities with the options market. With wheat, wheat was one of the numbers we were looking for a change yesterday. We were looking to see what USDA said on production on winter wheat. Didn't change a whole lot versus last year, or last month. Actually, they increased production 17 million bushels due to an increase in the yield of 0.5 bushel an acre. You can see the breakdown right now. Hard red winter wheat went up 21 million bushels. Soft red was down 2 million. White wheat down 3 million. So you can see where that came from. You can see by state here what was changed versus last month. Nebraska, Kansas bumped a little bit. Oklahoma, Missouri, South Dakota all up slightly. Illinois down a little bit. You can see some of the other states to the east see a little bit of a dip there. Montana with a record winter wheat yield at 51 bushel per acre. So kind of interesting there. Looking at the balance sheet again, USDA raised production, raised exports as well. Did lower ending stocks just slightly. The one thing they did do, the one major move was in this average farm price. Took it up 50 cents a bushel from $6 to $6.50 a bushel. Reason for that is what's going on overseas right now. And this Russian crop has given this market a boost that we didn't see coming about a month or so ago. And you look at these two maps here, where the Russian wheat crop has grown, primarily in southern Russia. When you look at the precipitation so far, they've seen a lot of dry conditions in the month of May, especially up here into this central area. And so maybe not the heaviest growing regions, but still big influence on that market. And that's following the frost that they had hit on the wheat crop back about 2 months ago. And so you went from freeze frost to drought. And so everybody's talking that crop down a little bit. If you look at the world numbers in the report yesterday, these were the biggest changes. USDA did raise the U.S. crop, as I mentioned, but they lowered the former Soviet Union 6.5 million tons. This is combined Russia and Ukraine. That's in agreement with most everybody around the trade. The EU crop was down 1.5 million tons. So total over there, you took the crop down 8 million metric tons. That's a big change. But USDA also lowered world demand for wheat, took imports and exports down, took domestic usage down. So actually, the ending stocks only dropped 1.34 million metric tons. And that was bearish because everybody in the trade thought if we took production down 8 million tons, we're going to lower ending stocks 6 to 8 million tons. And that didn't happen. Still, if you look at the overall world stocks to use, that number's continuing to work down a little bit. So it's friendly, but it wasn't as bullish as what we were anticipating. And so the wheat market did sell off yesterday following the U.S. report. Looking at stocks here in the United States, we're going to grow stocks for the second straight year, but at the world level, we continue to go down a little bit. So everybody's watching the world situation right now in wheat to see if we get any kind of a additional rally to this market. You look at the Chicago position from the funds. They had took their net position from short more than 100,000 contracts this spring down to short about 31,000 contracts as of last Friday. So they've bought back a lot of wheat. It's given us a heck of an opportunity in the market. That said, that opportunity is kind of left here over the last few weeks. And so, you can see where we've gone from April when the funds bought. They rallied this market $1.70, and now you've taken it down about $1 off of that. And it's well into the oversold zone. RSI in the low 40s, stochastics down to 12. So we did find some support, it looks like, at the 100-day moving average line at 604. And now the market's trying to nudge back up a little bit. So we'll watch this situation in Russia, especially, see what their crop does. But we do have this headwind in the United States called harvest right now. We're getting into harvest in the southern states. You start to see wheat move out of Texas and Oklahoma and some of the soft red wheat states as well. So that's going to continue to give us a little bit of a headwind as we go forward. Kansas City wheat, similarly rallied nearly $2 a bushel, and now we've sold off over $1 of that as of this morning. But again, the market very oversold. We've got this in the not zone right now at 39 on the RSI, and stochastics dipping down into single figures. I think it's probably a decent buy right now. But again, we do have harvest right now that's going to continue to keep a little pressure here in the United States. Spring wheat, again, very similar looking chart. We rallied $1.30. And by the way, I should have pointed out where we had these markets in the hot zone. You had the RSIs in the 70s and stochastics in the 80s. We had opportunities to market, and hopefully we took advantage of it, because now we're down $1 off the highs, and we're definitely not at a point I want to be doing any marketing right now. We're down below the crop insurance price on Minneapolis September wheat. The only positive is if you bought margin protection insurance, that price was at $8.05. So we're well below that, and probably in the money right now on that option, that put option that's built into the margin protection policy. Finally, in cotton, USDA did make several changes, but it was bearish. They lowered exports, which maybe the trade had already factored some of that in, but they took us down about 400,000 bales, which rose ending stocks, and that carried into the new crop. And now we're looking at a 4 million bale carryout next year. And so that is not a good deal, but I think it's already probably been priced into the cotton market. If you look at the world situation in cotton, stocks have risen back a little bit. So, but stocks to usage is expected to be down a little bit this year. So, the negative numbers have been the China numbers. And, if you look at especially the inflation rate in China back in October, November, December, January, we were looking at negative or deflation. Now we're seeing that start to go back to positive numbers. And so the cotton market may be hopeful that we're going to see a little, improvement there, and maybe start to see their economy tick back up to where you would start seeing some demand. So that's what we're all hoping for. We'll see if it plays out. But the funds had taken their net position in cotton from near record or record long this spring. It gave us a great opportunity. We were up over a dollar cotton, and now we've gone down to 70 cents with the selling of the funds. So funds are short about 20,000 contracts as of last Friday. We'll see what they decide to do from here. But looking at the chart is kind of rivaling beans, I guess, for being oversold. We've made, or I should say, the hog market. We've made new lows in July cotton. Indicators very, very oversold right now. We need to get back above the 9-day moving average at 73 cents to give this market some life, I think. And what's realistic? I probably would have offers up here around this 85-cent level where the 200 and the 100-day moving average are, or maybe even target the high we had back in May at 83 cents if you had any old crop left to sell. New crop, again, very oversold, well into the not zone right now. We are well below the insurance price at 83 cents. If you multiply that by 10%, that's 8 cents, 8.3 cents. So 74, 75 cents, and where Stacks insurance, to me, provides a put. If you have an average yield in your county, then that Stacks policy starts to provide price protection. And we're there right now. So I don't want to have to be a seller right now. I'm going to sit on my hands and wait. Maybe you get back up around this 79-cent area where the recent high was, where the 100 and the 200-day moving average lines were, might be the area that I would target to be doing some hedging for this year. Again, just a quick reminder on the seasonal patterns. Now is the time of the year over the last 18 years when the corn market tends to give us its boost. This April, May, June window, when we typically make the highs, the average highs in December corn. After that, that doesn't usually happen. And so kind of keep that in mind. You get past June, Flag Day, June 20th. June 20th, I think, has been the high historically on December corn, if you look back over the last 20, 30 years. So we're nearing that date right now. Now's the time to be taking advantage of the corn market. Same with beans, but a little bit later, June, July, typically when we see our average highs in the bean market. Spring wheat tends to make its highs also May and June. And the cotton market tended to make its highs in the spring, but we're kind of well past that now. And, hindsight's 2020, but you go back and look at the cotton charts and maybe we kind of did that this year. So these seasonal trends tend to be pretty good indicators, and just, again, kind of keep that in mind. Crop insurance update. We are setting prices right now for harvest for winter wheat. For the southern states, we're about a third of the way through the month. The soft red price averaging $6.37. That's down about 3.6%. In hard red wheat country, $6.68, down about 9% from the base price. So depending on your coverage level for your revenue insurance, you probably would have to have a bushel loss as well in order to trigger a payment. But the price averages continue to work down as the markets are trending below what the running averages are. Northern states, we're going to start setting those here at the 1st of July. So we'll be comparing those to the base prices we had last fall as well. Lastly, I want to finish up with some talk about the Farm Bill. We've had a lot of discussion about a new Farm Bill for the last couple of years. Here in the last couple of weeks, we've had the House, the Senate, Republicans, Democrats all put out what they'd like to see in a new Farm Bill. So now it comes down to, can they get together? The latest thing from the Senate GOP has been that they want to put the farm back in Farm Bill. The estimate I saw come out this week was a $1.5 trillion farm bill. I don't think money matters anymore in Washington, D.C. What's another trillion, right? It used to be what's another billion not very long ago. And now we're talking trillions. And so 34, 35 trillion, what's the difference? But that said, from our perspective, the farm perspective of the Farm Bill, and by the way, we got a tug of war going on right now, of course. The Republican side generally is more favorable to the farm side of things. The Democratic side tends to lean more towards the food stamp and the SNAP program, and so where the funding goes. And so we'll see what they can kind of put together between the two groups. But it doesn't, there's a lot of changes talked about that would affect crop insurance. as well as the PLC and the ARC program as well. And we'll talk about that later on. But regarding crop insurance, this is the current program that we have for SCO and ECO. And the reason I bring this up will be the next slide. But for SCO, the supplemental coverage option starts at 86% right now, and it covers down to where your revenue protection kicks in. That is the same trigger that the ARC program has at the FSA office. And you can only do one or the other. You cannot do both. You can add ECO on top of SCO up to 90 or 95%. You can do ECO alone, no matter which program you sign up for at the FSA office. The subsidy level for SCO currently is at 65%. For ECO, it's at 44%. Remember those numbers because we'll hit on them here in the next couple pages. Keep in mind that you have to enroll in PLC if you wanted to buy SCO. There were no restrictions for ECO. That is still going to remain the same from every number or everything I've seen from these proposals from both the House and the Senate. Now, this last few days, we've had several new proposals, and the House is proposing that we bump the SCO trigger to 90% from 86%. That would be a boost, nice boost. They would also be looking at bumping the ARC program to 90% as well. So again, you'd have to choose between ARC or SCO. That would essentially eliminate ECO at the 90% level. So then you could still add ECO from 95 down to 90 under this proposal. What's really interesting about this is with SCO, they would increase the subsidy to 80% from the current 65% level. That's a big, big deal. And so, and it kind of resembles a little bit more closely to what we see with the SNAP, or excuse me, with the, I'm blanking out here, the cotton program, that Stacks program, thank you, that the Stacks program is at 90%, but an 80% subsidy. So SCO would essentially mirror Stacks that we have for cotton that we've had since 2017. The Senate proposal isn't quite as great. They're talking about 88% for SCO instead of 86 that we currently have, but they're still talking about an increase in subsidy up to 80%. So kind of curious to see, where this lands, but it looks like both houses have, a proposal to bump this coverage level for SCO. ECO would still remain either 90 or 95%. But the nice thing about ECO is not in the farm program. It was developed outside the program. And already, this has already been approved by the FCIC for next year. We're going to bump the ECO subsidy level to 65% from the current 44%. So what's happening in DC right now seems to happen about every 20, 25 years, where they're trying to, we see this period of ad hoc disaster programs, and then the Congress gets together and decides that why don't we just bump the farm program or crop insurance to get rid of ad hoc disaster programs? Then 20 years later, they decide they need more ad hoc disaster programs, and then we end up bumping the subsidy levels or whatever. So we're in a positive mode for production agriculture, for farmers, in that these subsidy numbers are all getting better, which is going to cheapen up the cost of ECO, SCO, these add-on type programs. So we'll see, what the premiums look like next year. But again, this is positive, and the government is trying to step up and trying to get producers to be able to add coverage, to add these higher coverages so they wouldn't be relying upon any kind of handouts. The rumor is that the margin protection subsidy level would follow ECO, go to 65%. I haven't seen that in writing yet, so it's just a rumor at this point. But those two policies tend to be somewhat similar. They got some similarities. So we'll see if that does happen. And then, of course, we'll follow what happens in the House and the Senate and see. If you get my daily market report email letter, I've attached this information to it. These were the Senate Title I and Title 11, the commodity title and the crop insurance title. You can read through what their proposed changes were. I also did a video recently It's on our YouTube channel, the Thinking Cap video, talking about some of these changes as well. So you can check that out if you want to listen a little bit more in detail. But so some good news for producers, and we're just not sure how good the news will be at this point. And so we'll have to wait and see when the Farm Bill finally gets passed. So coming up, what's happening? Well, we got another big deal coming up over the next 24 hours. We think by June 14th, the RMA has stated on its website that it will release its 2023 final county yields. And so I hadn't seen them yet as of early this morning. We'll continue to watch, but by tomorrow sometime, RMA is going to release those final county yields. Why is this a big deal? Well, any producer that bought the ECO coverage, the SCO coverage, margin protection, RPI, the old county policy, all of those counties use, or all those programs use these county yields. So we are supposed to get those numbers out by tomorrow. We will be watching closely for those and try to get that information out to your agents as quickly as possible. And then hopefully checks would come shortly thereafter. The markets are going to be closed next Wednesday for Juneteenth. June 28th is a huge day. That's our planted acreage report. So we'll see what USDA does with those acreage numbers. In addition, that day we'll get a quarterly grain stocks report as well. But that's a week, 2 weeks from Friday. The following week, we got a holiday. Independence Day will be on July 4th. Markets will be closed that day. July 12th will be our WSDA report. July 15th will be our next aftermath. So a lot of stuff happening in the next couple of weeks, along with a couple of market holidays. So a lot of things to be thinking about there. And with that, if you had any questions, I should have mentioned you could put those in the chat. But otherwise, you can shoot me an email off to the side, and I'll be happy to share any information with you. Appreciate the opportunity to visit with everybody this morning. Thanks for listening to the Aftermath. And we'll continue to keep you up to speed on what's happening through the market report email and through the opening bell phone call and through some Thinking Cap videos as well. So take care. We'll talk to you again soon.